Welcome back to another video. In today's video, we are going to be covering Hims and Hers, their earnings, and see if right now is a good time to buy. And we're going to do the same for Palantir. Very short, go over the earnings and see if right now is the right time to buy. If you're new here, my name is Jorin. I'm a quality investor and I write about quality companies on Substack. You can check the link in the bio, head over to Substack, and you can subscribe for free. And there you can read my write-ups on companies and just write-ups in general. With that said, I'm not going to take more of your time. We're going to get straight into the earnings of Hims and Hers. In front of me, I have the Hims and Hers earnings. I use FinChat to review the earnings. I always do. They recently input these generate AI summaries option. It's perfect. It just generates a summary for you. If you do want to give FinChat a try, you can give it a try for 2 weeks using my link in the description. I am affiliated, full transparency, of course. So let's go over the earnings. Hims and Hers reported strong Q1 2025 results, with revenue more than doubling to 586 million. That represents a 111% increase year over year. Adjusted EBITDA nearly tripling, reaching 91 million, a 182% increase. The subscriber base grew 2.4 million, a 38% increase, with over 1.4 million subscribers using personalized solutions. The company is focused on long-term growth, aiming for at least 6.5 billion in revenue and 1.3 billion in adjusted EBITDA by 2030. So online, I saw a lot of speculations that people found it odd that Hims is projecting 5 years into the future. But they've done this previously. They've achieved those numbers actually, so it's not something odd to see for Hims and Hers. If a company suddenly does it, I would be a little bit sketched out. But Hims and Hers has done it before, so nothing to worry about there. Actually, a very bullish signal to me. They have a clear vision and they know what they're fighting for, what they're striving to. So I think it's a pretty bullish signal. They keep doing it, so it shows confidence in my opinion. The company is focusing on 5 core drivers of growth: deepening personalization, expanding into new specialties, low testosterone and menopause support, elevating precision care, building strategic partnerships with Novo Nordisk, and scaling globally. The weight loss has become one of their largest specialties in just 18 months, and the collaboration with Novo Nordisk is a pivotal milestone. This is truly one of the best things that could have happened to Hims and Hers, this partnership. Novo Nordisk has Wegovy. Now Hims and Hers can add Wegovy into their plans, and that would give customers more for their money. So there's a lot of customers who are either not insured or their insurance doesn't cover Hims and Hers. So there's a very high barrier to getting a subscription with Hims and Hers because, yeah, it's a hefty price. But now you're offering more for pretty much the same price. So those people who were doubting are now going to be buying. So I think it's going to boost their paid subscribers significantly. And it's just expanding their offering, which is always good. It's very complementary to what they're already offering. So it's a perfect collaboration on Hims' part. The company acquired an at-home lab testing provider to integrate diagnostics into the platform. This was also a perfect acquisition. They acquired at-home lab testing, this just smoothens out the supply chain. So less errors, more control over everything. So perfect acquisition. The company expects revenue between 530 million to 550 million for Q2 and between 2.3 billion and 2.4 billion for the full year. Adjusted EBITDA is expected to be in the range of 65 million to 75 million for Q2 between 295 million to 335 million for the full year. In short, I'm not gonna say too much. It's perfect earnings. These are what Hims and Hers needed, especially seeing the valuation of Hims and Hers. They needed this kind of a banger of a earnings release, and they delivered, which is really good. So here we get a overview. Revenues 586 million, net income 49 million, adjusted EBITDA 91 million, operating cash flows 109 million. Last year it was 26 million, so that's a 322% increase. Free cash flow 50 million. Last year it was 12, so that's a 321% increase. Subscribers 2.4 million. Last year it was 1.7 million. And this is a very important one: monthly online revenue per average subscriber. Last year, it was $55. Right now, it's $84, a 53% increase. That is just bizarre. Are they going to keep this kind of growth rate going. I doubt it, especially on the monthly online revenue per average subscribers. They can continue to boost it, but I don't think it will be as significant as this one. Maybe for the coming quarters they could. Not with 53%, of course, but at high double digits growth rates could be possible. They're in their growth phase, so I do think we should still expect some spectacular growth, but do account for some slowdown. As a company gets bigger, their growth, usually the normal route, growth slows down because you have the law of the large numbers, and at some point reaching or getting these kind of growth rates is just unachievable. But overall, very good here. What is not noticed is that their gross margin took a little hit. It declined actually. And this was the result of their GLP-1 customer acquisition with accelerated adaptation of longer cadence SKUs, and primarily offset by ongoing benefits from economies of scale, in part due to increased volume at their affiliated pharmacy and lower costs associated with medical consultancy services as a percent of their revenue. So it took a small hit, but they've explained it very well. I looked into their in their earnings release, explained it very well. No biggie for me. All the other margins are still improving. So overall, I am not worried on that part. Gross profit took a slight hit. Who cares? There's a good explanation for it. And it's not something that's likely going to persist and likely going to keep impacting the gross margins. So I'm not really worried about that. So here we can see that in 2030, they want to reach 6.5 billion in revenue, at least 6.5. And in adjusted EBITDA, they want to see at least 1.3 billion. That's good to see. So right here, we do see something pretty interesting, actually. We see a share of total subscribers utilizing a personalized solution. We can see that the non-personalized solutions, it has been somewhat stable. We see a slight increase here, or stability here, and then a slight decrease, and then it just stays stable like that. And I think this is good. They should not be focusing as much on their non-personalized solutions. They should be focusing on personalized solutions. And it's good to see that this is increasing. It means higher customer engagement, growing trust in the brand, improved lifetime value of the product services. It's a better product market fit. And overall operational scalability and personalization. They're scaling their offering, and that means they're scaling their personalized offering, which means they've likely enhanced their back-end systems like AI, telehealth, and pharmacy fulfillment. So these are all very good signs here, and I'm very bullish for Hims here. So that was the earnings we just reviewed. Let's go over to see if Hims is actually worth buying right now. For Hims and Hers, we're going to be looking at the price to gross profit and the forward EV to sales. If we look at the price to gross profit, the median since September 2019 all the way till now, 6 years-ish, the median has been sitting around 4.45, especially even with this big spike here. And right now, Hims and Hers is trading at an 8, so that's pretty expensive. And also, if we look at the forward EV to sales, also the same period, we can see that their median has been 2.05, and right now they're sitting at close to a 4. So Hims is definitely not cheap. Definitely not cheap. Even if you're considering the growth that they're experiencing and the growth they're going to get in the coming quarters or maybe even years, Hims is not cheap at all. I would not consider buying Hims right now, even though it's a wonderful company. They're benefiting from a very strong and a little unhealthy secular trend, obesity. But they're also getting into, as mentioned before, the testosterone and the menopause. Very big industries, very large amount of consumers you're reaching. Every male has to deal with their testosterone, and every female that's hitting... At what age do you hit menopause? 50? I don't know. I'm not really sure at what age. It really depends on the person, but I think the average is somewhere of 50, maybe even a little bit younger. So let's say 45 and above, then you reach the menopause for the woman. That's a lot of people. Huge market for this. I think there's a huge total addressable market for Hims and Hers. They definitely will be capturing a large piece of the cake. But even considering in all these factors and the growth that they're going to experience, the partnerships, the expanding of their offerings, this is just not, you can't buy HIMS at these levels and expect a long-term positive yield, in my opinion. If HIMS and Hers would drop a little bit in price, I would consider getting in. It's a wonderful business, but right now I would just not get in. With a 4 EV to sales and almost an 8 price to gross profit, looking at the median, it's just too expensive for me. Excellent business, just too expensive for me. So let's go over to Palantir, go over their earnings really quick, see at the valuation, and that will be it. Here are the earnings for Palantir. Let's go over them really quickly. US revenue grew 55% year over year and 30% quarter over quarter to 628 million. US commercial revenue grew 71% year over year and 19% quarter over quarter to 255 million. US government revenue grew 45% year over year and 9% quarter over quarter to 373 million. Revenue grew 39% year over year and 7% quarter over quarter to 884 million. With the Rule of 40, they scored 83%, which is bizarre. For the people who don't know, the Rule 44 or the Rule 40 is a principle that states that a software company combined revenue growth rate and profit margins should equal or exceed 40. And as you can see, Palantir is double on it, so that's perfect. Palantir closed 139 deals of at least 1 million, 51 deals of at least 5 million, and 31 deals of at least 10 million. Adjusted free cash flow of 370 million with a 42% margin. Adjusted operating income of 391 million with a 44% margin. US commercial remaining deal value grew 127% year over year and 30% quarter over quarter. And they noted their highest ever quarter of US commercial total contract value of 810 million. That's 183% year over year. These are stellar earnings by Palantir. It's good to see that commercial is growing faster than government. I know commercial is a crucial aspect to Palantir. Commercial has, they can upsell better at commercial and they have better margins at commercial plays. So seeing this grow faster, that means that their margin expansion path is going to go even faster. I think this is very good. They've also been able to upsell a lot because if we're going to look at their net dollar retention, so we're going to go to segments and KPIs here. Net dollar retention, as we can see below here, is 124. So if you have 100%, they buy one product and they just keep that product. Anything above that, they're managing to upsell other products and services. Ideally, we would love to see something above 110. And in this case, they're at 124, which is just perfect. It's very good results for Palantir. So again, also Palantir, they hit the ball out of the park. They hit a home run. Very good earnings. They did dip down a little bit, but that's because of the thing we're going to look at right now. And that is the valuation for Palantir. So here is the chart of the valuation of Palantir. I'm not making this up. This is bizarre. So in the case of Palantir, we're also going to look at the EV to gross profit and the forward EV to sales. High growth companies, I prefer to evaluate them based on these metrics. Free cash flow can be very sporadic, can be all over the place. The same with operational cash flows. That is more reliable with companies like Microsoft and Amazon, just the bigger players, more stability. Even then, free cash flow is a little bit because of reinvestments. But again, here we're going to use EV sales and forward EV to gross profit. Here we're also going to toggle the median, and I'm just flabbergasted. It is bizarre. If you're not calling this a bubble, I don't know what it is. But their forward EV to sales has been pretty high since last year in November. Well, I would even argue right here above the median somewhere here. So yeah, beginning November of 2024. Their average median since October 2020, so it's roughly 5 years, sits at 16.43. They're right now at 75.94. It's just It's insane. The same goes for their EV to gross profit. The blue line right here, their 5-year median is 25.78. And right now, they're sitting at 124.80, to be precise, 79, but let's just make it easy, 0.80. If this is not a bubble, I don't know what it is. Nobody can justify this kind of valuation. Also, not with the type of growth that Palantir is seeing. It is just bizarre. Palantir is just way too expensive. Even if we put a premium on the 5-year median, let's say the EV to gross profit, instead of a 25.80 median, we could say we'll add a little premium. We could say that 27 or 28. Even then, Palantir is way too expensive. So it's a wonderful company. They truly do have a chokehold on the data analytics with the governments and also now commercial. Showing excellent growth. Dr. Karp, I think, is the CEO's name. Excellent guy, a very down-to-earth guy. I like watching interviews of his. He's amazing. He recently, I don't know if it's recently, he did an interview talking about short sellers being all coked up, and it's a funny guy. I like him. I have to give him that. But I'm not going to pay this kind of premium just because you're funny. This is just bizarre. I would rather buy Hims than Palantir right now. But besides that, it's a great company, but the valuation is just not working along it. So they both reported solid earnings. Hims overvalued. Palantir, this is a bubble. This is nothing short of a bubble. It's bizarre. I would not buy either Hims or Palantir at the current levels. If I had to pick between one of these, definitely Hims. But this is just getting too crazy. But hey, everybody got their own thing, right? I don't think you're going to get a positive yield, portfolio return yield, if you buy right now in Palantir. But overall, wonderful companies, wonderful earnings, nothing short of just excellent. The valuation with both of them is just sitting in the way. And that's my personal opinion. Do share your personal opinion. I'm really curious. Do you think Hims is a buy right now? Do you think it's a hold? Is it a sell? The same for Palantir. What do you think right now? If you say Palantir is a buy, I'm deleting your comment. Palantir is not a buy. No. All jokes aside, I hope you enjoyed this video. If you did, consider leaving a like and subscribe to the channel if you're new. One last reminder, you can try out FinChat 2 weeks for free without using your card information. Check the link in the bio. And also check my Substack. I post really in-depth articles on quality companies. I think you'll enjoy them. I think they'll add tremendous amounts of value. And with that said, I hope to see you in the next one. Cheers.